Hey folks, welcome to Long Shots. And today's guest is Mr. Viram Shah, CEO of Vested Finance, a platform which enables Indian investors to take exposure of US listed equities as well as theme based ETFs. Formerly from JPM, used to cover Asia TMT. So, Sharad, we have another. I would say former investment banker with us. Very excited to have this chat.
Yeah, I think we're getting a few of those recently, but today should be fun because the FANG stocks sort of narrative has become so popular in India as well, and anyone who's looking at stateside U.S. equities, kind of Vested is a vehicle that I think shows up quite often. So should be an interesting chat. Viram, thanks for your time and thanks for being here.
Thanks for having me. It's great to be here and great to connect.
So Viram, naturally, there is a kind of thematic relevance to that entire narrative of Indian investors looking in an outward manner. Obviously, when you look at innovative business models, big tech, US gives those opportunities in plentiful, and Vested obviously as a business is structured around that market. Just want to get a sense from you. You kind of sit on a very interesting vantage point of looking at both India as well as the US. What's your take on the markets, man? I mean, how have the last 6, 7 months been from your perspective?
I mean, they've pretty much been something that we've never seen before. I mean, even in my relatively short career covering markets across the world, these times have been completely unprecedented. During COVID, there was this I mean, the peak of COVID, I would say, there was this entire time period when everything was just uncertain, everything was crashing, nobody knew how things were going to go, and then suddenly we saw this. There was always these questions: how is the recovery going to be? Is it going to be U-shaped, W-shaped, V-shaped? And still the jury's out as to how things play out. But we've seen this kind of a V-shaped recovery, right? The markets have bounced back, especially in the US. There was an entire time period of a few weeks when the Indian markets were not doing well at all, but the US markets were doing very well. And so I think that entire time period has helped raise a lot of awareness in general about the need to diversify internationally, how tying yourself to one country or one market might not be the best way to build your portfolio. You should have some kind of diversification so that you can take advantage of opportunities across the world. And so that was kind of a catalyst during COVID for just generally US investing. Overall, I mean, we're still in unprecedented times. The US economy is still not doing that well. The Fed is printing insane amounts of money, and the US stock market is going up and up. Kind of how do you look at the markets is something that we are closely tracking. And as per our analysis, I mean, what we've seen historically is that the correlation between the GDP of a country and the stock market, especially in the US, is very low. So essentially what ends up happening is the stock markets are a reflection of what the people believe is going to be the future, and they end up being a store of capital. Essentially, there's no other capital source. There's no other area where people can pour in capital. Stock markets serve as one good area. So that's what's reflecting a lot of the increases in share prices, especially the technology companies, which are kind of becoming like a safe haven of sorts, especially in an area where in a world where digital is going to be the key leader. These companies have immense competitive advantages, have a lot of cash on their balance sheets. There's nothing to say that they won't become larger and larger. So that's what's leading the rally in a lot of these large tech companies as well.
No, absolutely. I mean, when you look at big tech, definitely, with this entire primary focus on social distancing as well as, work from home culture. I mean, it's kind of it now comes as no surprise that the relevance has only enhanced. I mean, the funny thing is that there was a lot of regulatory scrutiny upon big tech pre-COVID, and even that scrutiny has diluted over time, considering the newfound importance that these stocks have, and it's kind of showing in the price. But on the flip side, there's also that entire theme that the fact that the Fed has been going through almost 10 years of low interest rates, a lot of quantitative easing, that asset prices no longer reflect the fundamental value, and that theme is also kind of shaping up, I think, now slowly in the Indian markets. What's your take on that?
Yeah, I mean, we definitely follow the US markets more closely, but even in the Indian market, in fact, across the world, this theme is playing out. We are seeing never before amounts of liquidity, and even in the Indian markets. And what happens, and what is happening in the India markets as well, is that liquidity goes to certain companies, and that those stock prices get reflected accordingly, and kind of move away from fundamentals. And so similarly, that's what we are seeing in the Indian markets as well. And kind of the opportunity, sort of pool of opportunity in the Indian markets, it's either the large companies, the likes of HDFC, Reliance, or you have to really pick the gems out of a lot of smaller companies. And people who are able to do that, spend the time to be able to do that, really can benefit from the growth of the Indian economy. But otherwise, you have these certain set of companies that you would want to invest in, and those get benefited because of this liquidity.
Yeah. And, I find it interesting. You talked about GDP and the correlation between the GDP and sort of the broader index or stock prices as such. It's funny when the GDP is struggling, that's when the printing press comes out all guns blazing anyway, right? So it pushes the market upwards. So there is a little bit of a statistical noise there. But generally speaking, like the Fed you guys follow the US markets closely. The Fed has sort of moved, recently to an average 2% inflation target range. And what that essentially says that rates are bound to stay kind of low for the foreseeable future. And this is a theme that we've seen that, for a long time now. But broadly speaking, the Indian markets generally, again, I know you guys follow US closely, but the Indian commentary seems to be, that's sort of good, in a low interest rate environment bodes well for the domestic equities, and it also helps the US equities as such. So in such a time, right, and especially because your audience is so niche in the sense that primarily, I guess it's a lot of it is Indian who are looking for exposure to US. How does that, how do you tie these things up that preferentially what benefit does the US economy or the US stock market give in terms of absolute returns versus the Indian? How do you think about such things?
So there are kind of multiple themes that we educate our users on, and one is just this underlying theme of diversification.
Mm-hmm.
If you look at our portfolios in India, historically we built them. I mean, the large masses, I would say, built them on three pillars of diversification. So we built them on asset-based diversification. So we invest across real estate, we invest across stocks, different kind of assets essentially. And then we diversify across industries. So we put some money into pharma, some money into IT services, banking, and we do it across different time periods. So we don't do it all in one go. SIPs have made it a culture to diversify the time in which you enter the market, and so we're time diversified. However, this fourth pillar is what we want to add to people's portfolios as an additional sort of allocation, is this geographic pillar, is this geographic diversification pillar. And that's where essentially we talk to people about why it's important, why moving away from a single country, single currency risk is something that is helping your portfolio become better. And so a certain portion of your wealth should be allocated to geographic diversification. So that's the one big theme that comes across. And the second then is getting exposure to, again, industries that you don't have exposure to here. So that's largely the technology industry, which has been led by, of course, the big techs, but also a lot of emerging technology companies that are being listed in the US markets are already listed. Like, for example, CRISPR is one technology that you can get exposure to, or let's say cloud computing or artificial intelligence. So if you are a person who believes that technology is the future, there are certain technologies that are going to define the future, then you should be investing some of your money there. And so that's another theme that a lot of our users or investors look at. And then the third is just purely diversifying currency. I think that's one thing that we've never gotten the chance to do. It's basically investing in dollars. So if you look at one's portfolio here in India, of course, most of it is INR based, and over the last 10 years, the rupee has depreciated about 3 to 4% every year, year on year over the last 10 years. And so now you have the opportunity to benefit from that 3 to 4% depreciation by investing in dollars, and why not take advantage of that? So these are the three large themes that we see play out when people start investing into the US market.
You know, on the currency side, it's very interesting because from an institutional perspective, it makes a lot of sense. But institutions can also take currency hedges to kind of ensure that any kind of a USD INR volatility doesn't really hit their absolute returns in a major way. But how do you address that for a retail investor? You know, I mean, ideally, you would like that when the investor is putting in money at that time, you know, you're looking at an appreciating rupee, and when the money is actually drawn back in, then you would rather have a depreciating rupee. I mean, but that's not how the overall trajectory always pans out. I mean, obviously, long term, you have a thesis internally of looking at a depreciation trend between USD and INR. But I mean, from a return optimization perspective, the direction kind of takes two different routes when the money is going in and the money is going out. And that is very difficult for a retail guy to control without any sort of a hedging instrument on top. So how do you kind of address that point?
A large portion of it is the fundamental thinking is that this is for the long term. You don't want to enter the US markets to be there for a month, 2 months, 3 months. If you're building a dollar-based portfolio, you definitely want to do it for the long term. So that is the fundamental thinking that one needs to have before they start investing into the US. And so then it becomes easier to look at a lot of the things. Like, for example, the currency depreciation is something that over the long term, just a crude way to look at it, as long as inflation is going to be higher in India, the currency is going to depreciate. So if you enter, say, at 73.50 or you enter at 75, it's not that much of a difference if you're in the market for the next 2, 3, 5 years.
Right.
And so that's how we recommend people to look at it. And then if you have that long-term thinking, then a lot of the other concerns are also alleviated. For example, how it has been with the markets currently in the US, the volatility that we have seen in the recent times. If you're in it for the long term, and if you see that kind of there is value being created in the companies that you're investing in, then there's no reason for you to be able to build your wealth by investing in them.
Yeah, no, that sounds fair. And you laid down the pillars, and diversification was obviously a key value proposition, right? For me, like personally, and being, I'm a vested subscriber as well. For me, one of the things that really appeals is that, for people who think that they're good at reading financial statements, who are good at picking stocks, I think the US gives a better environment to execute your playbook, just because higher corporate governance, better quality disclosures, more transparency in information. You just feel like the chances of getting rewarded for the right analysis is higher in the more developed Western world, and that sort of prompts me as well. What if you're a good stock picker? Why not look at the market, which is cleaner in terms of disclosures? That's a key theme as well, right? In terms of looking at the West.
Oh yeah, for sure. I think that appeals to the bankers in us to be able to have clean financials, pull them out, do some analysis, and kind of understand the company well. And given that everything is so structured, corporate governance is high in the US. That definitely is another underlying theme if you're somebody who studies the companies. And to add to it, another dimension is a lot of the information that we might have read as we developed our stock market knowledge or financial knowledge is often linked to the US markets or companies there, right? And so now you can start relating to those companies as well. I mean, for example, for all the Warren Buffett fans that are out there, everyone who's read his book can now also look at the companies that he was understanding and also be investors there. So those are some things that also appeal to a certain audience, and those also we see on the platform.
Yeah. And, just to look at the retail side, I mean, you guys are a retail product, and retail is something that is, retail investments have sort of, seen a little bit of uptick as well. We've been adding, I think, around 6 to 7 lakhs of demat accounts in the last 3 months average. And I think yesterday or last week, rather, Finance Minister Nirmala Sitharaman, she actually said the equity markets are lofty primarily or largely because of how the young retail investors are chipping in. What do you think about this? Is this a COVID trend largely, which, people have time, people are sitting at home, so people are investing and playing around? Or do you see this as a more sustainable shift in ideology and, it's appealing more to the younger folks?
COVID is the catalyst for sure, but underlying is definitely a shift in how participation in the financial markets is going to happen across the globe. Largely in India and the US. I mean, in the US also, where retail participation used to be at 10%, now it's gone up to 20%, largely due to COVID, largely a lot of students, younger folks getting onto platforms, starting investing. And the similar trend in India as well, as things become easier due to technology, especially opening up accounts, that trend plays out quite well. There is also a downside to it where, and this is something that people might have read around the downsides of Robinhood as well, right?
Yeah.
To an extent, it's too easy, and especially complicated products like futures and options or other derivative products. Those, if you start dabbling into it without having the right information, then it becomes tricky and you might end up losing a lot of money. So I think their financial education, financial literacy becomes very, very important. And so something that you guys are doing very well, and something that generally across the board needs to be done well as we are in this kind of information age. Sussing out the good pieces of information and providing it to all of these new participants becomes more and more important.
And, I mean, obviously you guys must be keeping a track of the retail participation from India into US. Like in terms of numbers, I mean, how has it panned out? If that's something that, we have clarity on at this stage?
Even if it's trend wise.
It's trend-wise, it's growing rapidly. I mean, high double-digit growth per month. It's definitely growing. It's still day zero, I would say, for just participation in the US market from India.
Right.
However, as the awareness grows, so largely for the first 6 to 8 months that we were in business, the question we always used to get is this even legal? Like, am I allowed to invest in the US market as an Indian resident? A lot of individuals just thought it's not possible, it's illegal to do it. And now those questions have shifted to, okay, how am I supposed to transfer funds? How does this entire process work? And so that is a very welcome shift to see in the investor population. And as we progress, I think now the key question is around safety of funds, around how the process works. Once those are alleviated, then we can go to the next step saying, okay, how do I discover the best opportunities and what are the different kind of opportunities available to me now that I have US market access also in the palm of my hand.
So say, I'm like, say you're talking to a first time, I won't say first time investor, but definitely a first time investor going into the US markets. Like now that person doesn't have much of a clue about the companies there, about their sectoral themes, right? How would you if you had to advise such a person, what framework would you suggest? Like, would it be start with an S&P 500 ETF and then over time develop the knowledge, or there are some very obvious themes that you already think are have demonstrated fair amount of traction, so go after them? How would you advise such a person?
So I think the first and foremost thing that any individual investing in the market should know is what is their risk appetite, and that is the thing that one should have in mind as we are starting this journey. The next would be what we always try to educate people is don't get super fascinated by suddenly getting access to all of these brands and companies that you have always wanted to invest.
Yeah.
What can happen is someone puts in, say, $2,000 into their vested account, and all of it is invested across Apple, Amazon, Tesla.
Sure.
Without knowing pretty much, how they want to invest, or without having any kind of strategy and taking their risk profile into consideration. So that's one big risk that somebody should avoid, is taking over risk rather than what their risk profile actually allows them to. What we always recommend for people to do to get started is look at an ETF-based portfolio. Keep it simple. Don't go for kind of all of the different types of opportunities that are available. Keep it simple. Either look at an index ETF if you want, or there are lots of ETFs that provide you some kind of sectoral exposure. Like, for example, there is a Vanguard ETF that invests just into the technology space.
Yeah.
Right.
So you can put your money into that if you want technology exposure. Or what we also do, so one of the things that we developed on the Vested platform are these things called Vests. And this was largely to solve the problem that you raised, right? You're starting new in the US markets. You don't know beyond Apple, Google what to invest in. And so we give them certain stocks, baskets of stocks. So pre-curated portfolios based on different themes. Like, for example, we have a portfolio which is called all-weather investing. It's a conservative portfolio meant for somebody who doesn't want to take a lot of risk. It invests across stocks, bonds, commodities, and gold. And in a way that Ray Dalio has talked about publicly, and so we mimic his portfolio.
Yeah.
It has given about 10 to 15% returns over the last 5 years constantly, and during periods of volatility, the portfolio does not is basically much less volatile than the market. So for somebody to get started, that's a good way to build a portfolio over, say, a shorter period of time. And then there are the higher risk portfolios that we have. Say, one, for example, is one which we call Moat West. So it's basically has underlying about 15 companies or so that have sustainable business advantages in their industry. Like, for example, there's Visa and MasterCard.
Right.
There's Apple. There's TSMC. So all of those companies optimize for risk versus return, and you can invest in them in one click. So looking at those kind of ways of investing rather than just being like, okay, I'm going to invest all my money into Apple, and because that's something that I always wanted to do, even though my risk profile doesn't suggest that, would be something that we try and kind of nudge people to avoid.
Yeah. No, it's interesting, and Nikhil and I, spend a fair bit of time as well, offline and online, in terms of just spending some time on financial literacy and, generally communicating that too. We've given a couple of talks as well. And, that's something that I've noticed, India might have had its own Robinhood movement and all, but it's very difficult for first-time investors to imagine or quantify risk. Returns, on the other end, is fairly straightforward. It's a mathematical number. 20% return is good than 10%, 30 is better than 20. But the risk is such an abstract concept that a lot of people struggle to understand it. And, it doesn't help because there are a lot of products. If you look at any mutual fund distributor today, they'll have 20 different funds and they'll have fancy names: growth opportunities fund, a value fund, hybrid, this double growth, whatever it is, right? And fundamental question people ask is, how can I make the most money? And that, because how the market is crowded with so many products, it becomes difficult for people to understand the concept of risk, right? Is that, and especially for retail folks, is that, how do you think about that? Because it takes an additional layer when you're doing cross country, and that is a very hard thing to communicate, right?
I couldn't agree more. I mean, I myself have been guilty of doing this, and I remember, so during my JP Morgan days, I learned finance, was super excited to use all the tools that we had learned on the job to kind of build my own investment portfolio.
Yeah.
And fell for this and ended up taking a lot more risk than I should have.
Yeah.
And so I learned it the hard way. That's one way to learn it.
Sure.
When you get burned.
Yeah.
The other is there is no shortcut, right? It's a longer term journey, and essentially one has to kind of develop that financial skill set or just investment building skill set to be able to do it if they want to do it on their own.
Yeah.
The third is you find an advisor, of course, somebody who specializes in this and does this day in, day out, or you use certain advice that is available to you through platforms and use that rather than trying to be that person who wants to beat the market and prove it to everybody that you created a portfolio that is performing great and above the market.
Yeah.
It's a very difficult thing to do.
Yeah, and because this whole Robinhood movement, it's not only giving birth to first-time investors, but the riskier end is first-time traders who are trying to do intraday trading and things like that, which is a very specialized skill set, right? From a vested standpoint in US market, like are there people who try to do intraday trade from a domestic standpoint? Because there is obviously a timing difference in terms of when the markets are open, so there's a whole time difference angle to it. But is that generally something that you're seeing happen? People dabbling on a daily basis and getting in and out of positions frequently from India in the US markets?
So luckily or unluckily, regulations have outlined that you cannot invest in speculative instruments in the international markets.
Right.
So we are unable to offer any derivative products in the US markets, which then means that anybody opening an account is actually just opening a cash account.
Right.
And they cannot do frequent intraday buying and selling. While you can buy and sell on the same day, you can't do that repeatedly. It triggers violations. And so it has largely become a platform more for long-term investing. And that's the way we'd rather have it if there are new people who are joining the market.
Yeah,
right?
No, sounds fair.
Well, this is very super fascinating. Obviously, would like to talk a bit about the just the logistics or the mechanics of Indians who want to take exposure to US, or I mean, I think you guys also look at other geographies, not just US. But before we kind of do that, I mean, just want to understand. You mentioned briefly that entire risk return understanding is super challenging to communicate. So from that perspective, what is the next step for you guys? Like, where do you see yourself head? Do you see yourself as like, you guys obviously have that West structure, which I think sounded very close to like small cases in India, right? Where you kind of have some sort of a structured module of curated investment opportunities, and you kind of frame it as a basket and make it available to your users. Is the idea to kind of become get more into that advisory and curation belt of the spectrum, or is the idea to offer more geographies, a wider gamut of stocks, or even in future once say regulations kind of change, also look at like derivatives and other more complex products? What kind of is what's the future plan?
I think in terms of where we want to position ourselves, we want to be somewhere between, say, Robinhood on one end, or any brokerage platform, and on the other hand, you have the robo-advisors, right, which is a complete black box where you don't know where your money is going. We want to be somewhere in the middle where we give the people who want execution capabilities. There are people who do their own research, or, for example, have been in a certain sector. Like, for example, I was just talking to a user the other day. He's worked in the healthcare sector since the last 20 years. Always knew of these global companies that have been powerhouses in the sector, but never really got a chance to invest in them. And so he really knows that industry well, and sort of that would be somebody who can take bets into certain companies that are listed in the healthcare space. So people like them should have the execution capabilities to go and buy what they want. Whereas someone who is more relatively newer to the US market should get some kind of a nudge and sort of advice on how they should create their portfolios. And so there we have a content strategy that we implement, which is across emails, so where we write a lot of content educating about different companies, and then of course these which are pre-built portfolios on the platform where somebody can buy and sell as per their risk profile and as per some of the themes that they believe. So we will definitely onboard more of these portfolios, maybe from third-party folks who have certain kind of research expertise and want to bring their portfolios onto the platform, and give both the options where if you want to come onto the platform, you should and buy what you want, you should have the stocks that you want to invest in, and on the other hand, you should get some hand-holding if you're newer to the platform.
Right, but how do you sell your differentiation here, in the sense that like there are like domestic brokers who do have tie-ups with US guys, major guys. If you look at like ICICI or Axis, you can kind of create a wealth account and get exposure to US equities. Obviously you guys have platformatized that entire experience to a certain extent. And on the other end, you also have the option of, taking exposure to like feeder funds where you actually put money in INR. You don't actually end up buying dollars. You are not going through the RBI's liberalized remittance scheme. And any kind of cross currency swap or any kind of hedging is done at the AMC level, and you get exposure to US equities through that as well. I think ICICI Pru does that, and there are a lot of other mutual funds which are structured that way. So how do you kind of differentiate vested?
So there are two ways to look at it here. One is, of course, kind of differentiating ourselves from the solutions that provide direct access, and then the other is how do you differentiate just generally directly investing versus investing into a fund of fund or a ETF that is an index fund. So on the second one first, picking between a fund of fund that is investing internationally or going directly, it really is the choice of the end customer. And it's the same as somebody picking direct investing versus like a mutual fund investing in the domestic India market. And so if you want the flexibility to be able to create your own portfolio and want to get exposure to certain companies that of course are not available through fund of funds, you don't have any control there, then the direct route appeals to you more.
Right.
Also, if you want to build your own dollar corpus, say sometime in the future you have a purpose for it.
Right.
If you have a specific purpose for it, say you debt route makes more sense. Just expense-wise, you end up paying a lot lesser for, say, for example, a Vanguard S&P 500 ETF, which is like 4 basis point or 0.04% in terms of expense ratio,
Right.
versus you pay 10 to 20 times more if you're investing in the same in India. So
Right.
those are some considerations. Of course, it's much easier for somebody to get started investing in a mutual fund, and so if you're not willing to take a little bit more effort, then those are the options that are better for you. So that's the second bit. On someone who has made that decision on investing internationally directly, what we will do is essentially we are somebody who's focused solely on cross-border.
Right.
And our goal is to provide the best experience end-to-end in terms of US investing. So one bit that is available right now is the execution bit, right? The platform bit itself. There are modules around it in terms of opening up accounts, KYC, fund transfer. All of those things still need improvement.
Yeah.
And so those are things that we are constantly working towards improving to create that end-to-end journey. And to add to it, the second layer is providing more utility for every dollar that is there on the vested account, right? So if somebody has $5,000, they should be able to use it not just to invest in the public markets, but they should have much more utility for the dollars. Maybe it's investing into different asset classes. Maybe it's using the dollars different ways. So those are things that we are looking at, and those are things that we want to offer to our user base.
Right. No, that's quite clear. And speaking from the perspective of the regulatory journey, like, could you just give kind of a short overview in terms of like the kind of regulatory framework in which Vested operates? I mean, I know that there's obviously like a $250,000 annual threshold which the RBI gives for Indians to put their money. But I mean, considering a lot of our listeners would probably be hearing all of this for the first time, it would be good to get that perspective from your end. How the entire regulatory mechanics works. You yourself said that a lot of people were in the beginning asking you guys whether you are legal or not. How does taxation fall through, and how does just the possession of shares, who's actually holding them, you guys, someone else? So it would be good to get a kind of brief explainer on that.
Yes, for sure. So I'll break it down into two pieces. So one is the regulatory in India, in the US, and then the second is taxation.
Right.
So on the regulatory bit in India, the RBI has very clearly mandated that you can do up to $2.5 lakh in terms of remittances abroad every year per individual.
Right.
And those remittances have been classified as certain purposes. So say, for example, you're sending money abroad for traveling, or you're sending money abroad for education or as a gift. Under those purposes, there are also investment-related purposes. So sending money abroad for equity investments, sending money abroad for real estate investments. So very clearly, this has been allowed by the RBI, and an individual who would be loading money into their vested account would be transferring the funds under this particular scheme.
Right.
The other is on the US side of things, being regulated by the regulator that is governing the trades that you're making, right? So here we, as Vested, are SEC registered, so we're regulated with the SEC in the US as an investment advisor, and have partnered with a broker that offers us execution and custody of funds. So that's how it works on the US side of things.
Right. So the custody is with your partner broker, correct?
So the partner works with third-party custodians.
Right.
And those custodians are ones who kind of work across brokers and hold shares with them.
Got it.
Yeah. So those custodians are essentially like holding billions or trillions of dollars of worth of shares. So on the taxation bit, there's capital gains and then there's dividend tax, right? No taxes are payable in the US. So everything is in India. And the way capital gain works is that there's a 24-month threshold for long-term investing. So here is a subtle difference between you investing into an international fund in India, where the threshold is 36 months, versus investing versus investing directly with the threshold is 24 months.
Okay.
So post 24 months, it's 20%, and you get the benefit of indexation. And if it's short-term, then it's as per your income tax slab.
Yeah.
And dividends, there's a withholding. So you basically get the dividend directly into your vested brokerage account. But there's a withholding of 25% in the US.
Right.
However, there is a double tax avoidance agreement between the US and India. And so you can essentially take credit for that dividend you paid here if you're in a lower income tax bracket. If you're in a higher, of course, you have to pay a higher income tax bracket. That's for your income tax. And so what we do at Vested is essentially simplify this entire thing. So we productize the taxation bit where at the end of the Indian financial year, we will tell you in rupees. So there are certain regulations of the RBI which tell you how you're supposed to convert foreign currencies into INR.
Right.
And so we will use all of those and give you in rupees what is the capital gains tax, long-term, short-term that you have to disclose, and how much is the dividend tax that you have paid, and how much credit can you get here, and what information you need for the different forms that you might need to fill.
Right. And there's an interesting angle which has come out recently, right, in terms of like tax collected at source.
Correct. That's something that again we've been closely looking at as well. The thinking behind it, and I can understand where the government is coming from, is essentially what was happening earlier was people sending money under the LRS either for travel or for education. About 20 to 30% of them, among the data that they surveyed, were actually not even filing taxes.
Yeah.
And that seems weird when you're sending money abroad, large sums, that you're not filing taxes. So it's largely a move to widen the tax net to get people who weren't paying taxes to pay advance taxes so that they can then, essentially have to file to get the credit. Overall, for our customer base, which is largely existing taxpayers, it's not an additional cost. It is an upfront cash outflow. However, what we've been talking to our users about is essentially, one is, of course, you can take credit when you file for your taxes, but the other is you can reduce your other tax obligations. So, for example, if you're a salaried individual, you can reduce the tax that gets deducted on your monthly salary to be able to offset the TCS that you've paid. So you can actually get your cash in hand much faster. Or if you're a business professional, say a proprietor, you can reduce the advance tax that you pay every quarter by the TCS that you've paid. So overall, not an additional cost, but more of how you can look at it from a cash management perspective.
But definitely, like, it kind of adds a bit of compliance burden, right? In a way.
It does, yeah. No denying it.
Yeah.
And Viram, like the stuff that you guys are doing at Vested, are there any international comps, if you will, or anyone startups or young companies who are doing something along those lines which you guys look up to or admire, or just have learn things off? Are there any other guys who have really cracked the space or are working hard in this area?
I think there are multiple, not one who we particularly look up to across the space. So I definitely look up to Zerodha here in India. What they've done is phenomenal, and really like the way they've gone about building the business over the long term without having kind of short-term growth or short-term revenue in mind. So very commendable what they've done there. Then there are a couple of companies out of China that did similar to what we're doing and went public in the US. These companies, there's one called Tiger Brokers, one called Futu. So those are definitely inspirations that essentially there is a market for people to invest in the US. Of course, they were supported by tailwinds of Chinese companies going abroad, Chinese companies listing abroad. But something that could be seen in India also not far away.
Hopefully, like documentaries like Dirty Money don't get made on those companies on Netflix later.
I hope so too.
Yeah, but obviously, we kind of discussed in great amount of detail about the opportunities. What about I just want to be a devil's advocate here. What are the constraints you see? Where do you, if suppose you had a direct, hotline with the regulator, and I know that's a tricky slope to always, tricky, territory to always get into, but what would be the one or two most significant market or regulatory changes that you'd like, especially from your business perspective?
I think just easing the money movement, given that it's coming from legitimate sources, there are multiple checks in place. Making it easier to move money and then bring money back is something that we'd love to see. The limit, I think, overall is enough, but just easing the processes, because our investment falls under capital account transactions. And so there are certain additional regulations there that govern how you can transfer the money. Like, for example, you can only do it through a bank, like an authorized dealer one. You cannot do it through a third-party authorized dealer. And so easing that, especially for this particular purpose, which is just public investment, investment into public companies, and of course you have the entire track of the money that is coming into the account, going out and coming back. So helping with that, I think, would be something that would be of great benefit.
I guess, I mean, even I'm assuming it must be costing around $15 to $20 every time somebody wants to put money from a remittance perspective, right? So I guess, anything below like $1,000 or a $2,000 ticket size kind of doesn't make sense for an Indian investor who's looking at a US exposure. And that has a lot to do with the kind of roadblocks into the remittance framework, right?
Correct, yeah. So, I mean, for smaller amounts, definitely not conducive.
Yeah.
And those are things that we are working on within the existing framework to reduce.
Right.
But yeah, of course, it would be helpful if overall the framework becomes easier.
Yeah. No, Viram, this was super fascinating, and I learned a lot.
Yeah, likewise. No, I mean, this is a product that we're aware of, and it was good to chat with you and walk through some of the intricacies in the space, and also just hear general views on the global markets.
For sure, yeah, I enjoyed it, definitely.
Great. No, I think this was amazing, sir, and I think we'll be back soon. Yeah? And with that, we can do a quick sign off this time. What do you say?
Yeah.
Yeah. So this is Nikhil Arora
This is Sharad Tupran
signing off.